This conference will now be recorded.
Go back to share. This was a nice, simple, basic program for a while, but then they made change after change after change, and harder to work with. Okay, we have two main topics left: cash and receivables, and then inventories. And we do depreciable assets a little after that. Let me just show you briefly here. Here's a balance sheet. And when we have depreciable assets, or any assets that have a contra account related to them, we subtract them. On the exam you had receivables less the allowance for bad debts, net receivables. Some people were adding the allowance to the receivables. Same thing when it got to property, plant, and equipment. We had plant and equipment less, it should have been less accumulated depreciation. People were adding it to it. So just be aware that when we do the balance sheet now, if there are accounts, contra asset accounts that have credit balances, you're not going to balance unless you subtract those items. And I don't think you have to worry about that. So let's look at the cash cycle. We start off with cash in the bank. We put it in. We purchase inventory. We pay for the inventory, and then we sell the item. We pay all the other expenses, and hopefully we have money to go back to increase our cash. And so this is that cash cycle from starting the company, purchasing inventory, paying off the inventory, making sales, cash sales, and collecting cash and paying expenses. So very simple cycle. But the control of cash is a big problem in organizations. How do you control cash? And of course, we're moving to a cashless society. Uh, but when cash is available, at all the retail outlets to still take cash, how do you control this cash? How do you keep people from taking money out? And so there are a number of things that we do. We have sales and cash receipts journals, and then we have a daily cash sheet. So the cash that's supposed to be collected is compared to a cash register tape to make sure it's there. Then we have a cash disbursements journal where we can look at all payments. So you don't see what we see now. We got just one journal, but actually you're going to separate those journals out. You post them to the ledger, but you're going to have somebody over sales and cash receipts journal, somebody else over the cash payments journal. Then that's going to be that daily cash sheet. Then you have a general journal for all the non-cash transactions. But we're just going to have more than one journal. Then we're going to do bank reconciliations to make sure that what the bank says there is correct. There are petty cash funds that cause people some problems. Not as much anymore because most time there's a debit card for petty cash transactions. Then we get into internal control. And of course, your assets, including cash. But all the assets have to be protected. And so a company has to have a strong process of internal control environment, control activities, information and communication, monitoring, risk assessment. So all of these are items in internal control. And if you can remember back to the early 2000s when a lot of companies in Houston got in trouble, Enron was the biggest one, but Reliant, CenterPoint, Waste Management, they all, they didn't have controls, and so they began to manipulate and work with their financial statements. And so the Sarbanes-Oxley Act was passed, and this act requires the president and the chief financial officer to certify that the statements are accurate. So the president can't say, well, I didn't know what was going on, and the chief financial officer can't say that. Once they certify, if anything happens, it's easy to put them in jail. So sometimes people were put in jail, sometimes they weren't in the early 2000s. And, and then we get this control, these internal control 5 components that we listed here. The environment, your organization should have a tone of internal control. It should be felt that this organization is moral and ethical. Risk assessment, you have to identify areas. How does COVID-19 impact our business? How does rising gas prices impact our business? Those are risk assessment processes that must be in place. Then there's information and communication. There should be a lot of feedback and so that people can do their jobs better and the communication will be there. Control activities, the policies and procedures, and then monitoring processes such as cameras, etc. All of these items are part of internal control that a company is supposed to have. So in summary, in internal control, we're trying to safeguard the assets, to process the information accurately. If cash comes in, we need to process it accurately. And we need to be ensuring that there's compliance with laws and regulations. We need to ensure that there's compliance. The elements of internal control, any company needs these items: control environment, risk assessment, control procedures, monitoring, and information communication. It starts off with the philosophy of the company. Does the company you work for have a philosophy of ethical behavior? So where do you work now, Martha?
ExxonMobil.
Where?
ExxonMobil.
Oh, ExxonMobil. So what
Mhm.
is the philosophy about internal control at ExxonMobil?
Well, they have an internal control process as far as the balance sheets are concerned, any journal entries, any income statements. It's all controlled internally and it's audited on a quarterly basis. The real audit is at the end of the year. Well, the main audit is at the end of the year.
Mm-hmm.
Um, um, and just we all have a sense of the gap analysis, all of that, and just the methodology of what we're doing, and um, just an understanding of how it should and should not be done, and how it cross references with the other departments that have to deal with it. From I work in finance and accounting, so from finance and accounting, all the way into like procurement and how everyone should handle their actual budgets and how we send the budgets up to the vice president.
Okay. Are the personnel all competent? Is everybody you work with, are they all competent?
Mhm. I mean, They should be. I mean, most of them, from my standpoint, yes, but you know,
And another part of this is what what do you control in terms of people? If a person's lifestyle changes, if they got close relationships with suppliers, if they borrowing from other people, if there's excessive use of alcohol and drugs, do you have controls in place where you look at each individual person who's working?
HR does. They do like random drug tests. They do like psychiatric analysis. When people are doing their reviews at the end of the year for the beginning of the year, they kind of see, how the work balance is controlled, within each individual, how that person is controlling their work life and their home life, making sure that that's together. And they also do like counseling sessions on
Hmm.
a quarterly basis to just make sure that everybody is, especially since COVID, to make sure everybody is like, having, dealing with a lot of depression and, things like that. So there's several, um, opportunities for people to speak up, if these things are hindering, their home life and things like that. So they try to work that out within their review, maybe take some of the pressure off, or divide it. Maybe they need to divide it more equally within a group.
Okay. Manuel, you there? Jasmine?
Yes, yes, I'm here.
Where do you work?
Not currently.
Oh, okay. Okay. Hi, so we'll bring you in on the bank reconciliation. Do you reconcile your bank statement, Jasmine?
Um, not manually, not really.
So whatever the bank tell you is okay with you, right?
For the most part, unless there is some type of discrepancy, then I do review and follow up more.
But what if you were running a company? What do you think would be the case then?
That would definitely require way more attentiveness.
Yes, that would require more attentiveness. And so if you're running a company, you got thousands of transactions, you got to have controls in place. And of course, a company like ExxonMobil has this treasury department and everything. Uh, so a key control tool is a bank reconciliation. We have the bank analysis where we look at what the bank has done. Then we look at the company analysis. And so with the bank component, we'll start with that balance on the bank statement. Then we're going to add deposits and transits the bank doesn't have. We're going to deduct outstanding checks to come up with a correct balance. With the company, we're going to do the same thing. We're going to enter the cash balance per the ledger. We're going to add credits that have been recorded, deduct debits that have not been that have been deducted by the bank. And both these correct balances have to be the same. That as we are reconciling the bank statement to a correct balance, we're reconciling the company's records to a correct balance. So that's what we always try to do. So let's look at this study problem. Sebastian Stevenson was a former student and he wrote this problem. On April 30th at 12 p.m., his bank balance was 20,000 at Chase. And then the balance per his checkbook was 20,000. So they were both the same. At 1 p.m., Chase posted the following. So this is after the 20,000 period time frame at 12. They added 500 to his account for interest income. They deducted 100 for service charges, and they said that his balance was $20,400 on the bank statement. At 6 p.m. on that day, Sebastian completed the following transaction. He made a deposit online for $3,000, so that's after 12 o'clock. He made a withdrawal of $500 for weekend expenses, and he wrote a check and gave it to his landlord so his rent would be paid on the 1st. And so his checkbook is showing a balance of $21,000. So the job for both Martha and Jasmine here is, what is the correct amount of money that Sebastian has? So you all take a few minutes and work on it. If this is your case, how much money do you actually have? So take 5 minutes and work on it. Are you all figuring out how much money does Sebastian have? How much actual money?
Should it be 25,900?
20, how much? How much did I just ask? Say it again. Okay, remember I said that we're gonna reconcile what the bank has to the correct balance. We're gonna reconcile what the company has. So in doing our reconciliations, okay, the bank does not have these transactions of Sebastian. So when we do the reconciliation from the bank balance to the correct balance, we look at these items. Then somebody says crisscross. Then we get ready to work with Sebastian, his information. We got to go back up here and put items on that the bank put on that he didn't have. So the checkbook says it was what? 21,000.
Mhm.
Okay. Checkbook said 21,000. Sebastian does not have the interest income. So he's got to put that in because he doesn't have his own books. So this is 21,600. Then he's got to put the service charge in because he doesn't have this. So that's, wait a minute, 21. The bank was showing, checkbook's 21,000. Add the interest 500, so that's 21,500. Then the unrecorded charges of 100, service charges. So if Sebastian puts in the items that the bank has, then he's showing that his actual balance is 21,400. See that? 21,400. Then we get ready to do the bank analysis. When we get ready to do the bank analysis, the bank showed 20,400. Okay. The bank does not have this deposit in transit of 3,000. Okay. So this gets it up to 23,400. 23,400. The bank also does not have, because it's, it's after that time frame, the cash withdrawal of 500 and the check for the rent. And those items are going to clear. So we have the cash withdrawal of what, 500, and then we had the check for the rent of 1,500. So that's $2,000. And we subtract the 2,000 from the 23, we get what? 21,400. So let's look at what happened. The books was showing 20. We got to put on the books anything that was on the bank. Okay, get to 21,400. The bank was showing 20,400. We got to put the personal items on there that the bank don't have yet and come out to that same number, 21,400. Are there any questions? Can you reconcile a bank statement now?
Yes, I have a quick question. So when we reconcile the bank statement, we're always just going to look at what the bank has and then adjust our records according to that.
Correct, because you don't
Okay.
have it.
Okay.
Then for the bank, see, but you still got to go to that bank statement and put on there these items, because if you don't, what if the bank made an error? So you reconcile both to the correct balance.
Okay.
All right, I got a practice problem for you all. We're going to do the A1 together. I'm going to let y'all get the correct balance based on this information for the A1. Then the B and C one will be homework. So for the A, you got the balance per bank, you got the balance per books, you got the outstanding checks and deposits in transit, you got the interest, income, and the service charges. What is the correct balance? Go through the company analysis and get the correct balance. Go through the bank analysis and get the same correct balance. Can you all do that? And I think I got this handout in course content, by the way, if you don't have primer. It is in course content. So take about 5 minutes or so and see if y'all can work that out. So that's a simple balancing of a trial balance. You know, y'all had some big balancing of trial balances. But the same thing, got to get to the correct balance. They got to be the same. Y'all got me a correct balance?
Second.
Okay.
Mhm.
Jasmine, a second is up.
Oh, I said just a second. I keep getting two different answers.
You're getting two different answers. Martha, what about
Hmm.
you?
That's me. That was Martha speaking. I
Oh,
said just
Martha.
a second, and I keep
Oh,
getting two
okay.
different answers. She
I
may
don't
be
know why.
done. Two different
Okay, two
answers.
different answers. Got to be the same. Jasmine?
I don't think I'm quite done. I think I'm
Okay.
slightly confused as to like what to add and subtract from which
Well, let's go
reconcile.
through it together.
Okay.
When you are reconciling the books in the bank, got to get the correct balance. So, first thing is the balance per books. The balance per book was 19.5. So let's put the 19.5 in. Got that?
Hmm.
Then it says plus interest income. So interest income credited to the account that you don't have. So you put 2,000 right here. Then less the service charge 500, because with the company, you're looking at things that the bank has done that you don't have a record of. And so what's our correct balance appear to be if we're looking at the company analysis?
21,000.
All right, 21,000. Now, for the bank analysis, we're going to go with the balance per bank. The bank showed $20,000. The bank does not have our deposit in transit of $5,000. So that's added. The bank doesn't have that. The bank also does not have these checks that have not cleared, outstanding checks, or checks, we've written them, they hadn't cleared the bank. So that's going to be here at 4,000. So 20 plus 5 minus 4 is 21,000.
Mhm.
Now, one more little caveat. Anything in this company analysis, we have to make a journal entry. This is interest income. So we're going to debit cash for 2,000 and credit interest income for 2,000. Mm-hmm.
What are you teaching?
Principles of Accounting 1.
Oh, okay.
They,
Go ahead. I mean, is 5 almost over?
we have about 20 or so minutes. Can you wait?
Yeah.
That's right. You got the next class. Okay.
I was just the only thing I came here, I have a class at 2:32, so I was kind of trying to get your presentation done at first, so I can like.
All right. Well, we'll do that first.
Okay.
I'll try to get there early. We have a presentation in class today from someone who had an internship and talking about the organization Beta Alpha Psi. So a couple of things like that we'll be doing in the class. The presentation for Beta Alpha Psi, that's also in course content on their assignments. But this is a student who's coming in, been on an internship and talking about the experiences. Now, anything that's on that company now, you got to make a journal entry for it. And as you got interest income, you got to record that. The service charge, you got to record that. These items you'd already recorded if they're on the bank analysis. So look at it. We'll go back over it next time. But you have a B one and a C one. You just got to make sure they balance. Okay? Then here's an A student bank reconciliation. Have to make them work harder. Make those A students work harder so they won't get lazy. Okay. Cash flow statement. Cash flow statement. There are 4 financial statements: income statement, statement of retained earnings, balance sheet, and then the cash flow statement. We talk about the fraudulent activities, but just in general, because we use accrual basis accounting, where we're putting receivables on the books and we have things to pay, we have to make sure we got enough cash to pay our bills. And so we have this other statement that just put the statements on a cash basis, therefore ensuring that we have enough cash to pay our bills. And I went down to the classroom and tried to make my presentation unit so I could be in the classroom, and it doesn't work. You can see the screen, but you can't hear what I'm saying. So they have a whole lot of controls in the classroom. But we'll see. Now, the statement of cash flow. It has 4 parts. Operating activities. These are the normal activities of a company. ExxonMobil buys gas and sells it. It has investing activities where ExxonMobil builds new refineries and pay for it. How do they pay for these investing activities, etc.? If you remember, the first journal entry we always made was what? debit, cash, credit, common stock. And the objective of the business is always, at the end of the day, to increase cash through earnings. To increase cash through earnings. Okay, that's always the objective. The income statement will show us revenues minus expenses, and the balance sheet will show us where we are at a point in time. But we've got to look and have a record and make sure enough cash is being generated. So there are 4 parts to the cash flow statement. Operations. This is where cash is supposed to come through. ExxonMobil is supposed to sell gas. Part 2, investments. ExxonMobil is not in the business of selling land in general, just buying land and selling it. So they start to sell some of their, selling their plants. They got a refinery and they sell it. ExxonMobil, to be doing well and growing, it has to what? To build more refineries. Well, they start selling those refineries, what's going to happen, Martha? What will happen if they start selling their refineries? What do you think would happen?
I was saying they were going to have more cash.
Yeah, it might have some more cash. But what happened
Mhm.
when the crude oil came in from the Gulf? What would happen then? They wouldn't have the refineries to do what?
To manufacture it or
To
to receive it.
gasoline.
Mhm. Yeah.
So what's going to happen eventually to their sales? You know, so that's what we're looking at. Uh, so if we look at it, and I'll come back to this in a second. Let's look at it here. We have cash flow from operations. This is where the cash needs to come from. We actually want this number to be negative. For growth, ExxonMobil has to be building new platforms to get the crude out and more refineries. Otherwise, it can't grow. It cannot grow if this number is not negative. Hopefully, it's paying off its debts. So for you personally, you would love to have a salary of, let's just say, $200,000. That's your operations. You'd like to be able to buy you a house, bigger house, new car, and pay, say, $75,000 for that. Then you'd like to pay off some student loans and still have some cash left. So personally, that's how you would like to kind of operate. Okay? A company has to operate the same way. A company has to have cash from operations. That's their salary. They need to be investing in oil fields and refineries if it's ExxonMobil, not selling them. If a company starts to sell them, it's like Macy's. If Macy's is supposed to be selling clothes, if they got money because they're selling their stores, then eventually that's going to catch up with them. And we want them to, at some point, to be paying off their bills. So 4 parts of the statement of cash flow: operations, investments, and financing. And so in this statement, we want the operations to be positive. We actually want this number to be negative. That means it's just like you personally. If you go work, get a job, and you can't buy nothing, and that's not the best thing. You want to be paying off your debts and student loans and have cash left over. When we look at companies on this statement, that's what we want to see. That's what we want to see. Now, when we do a statement of cash flow, only the journal entries from 1 through 11 are involved. If that journal entry is not 1 through 11, we're going to strike it out. We're not going to use it. So to prepare the cash flow statement, we look at the journal entries. And if they're 1 through 11, they're going to go on there. If they're not 1 through 11, they don't go on the cash flow statement. And there are places that they go. So the journal entries, and you got cash coming in 1 through 6, that's the source side. Cash going out 7 through 10, that's the use side. So we want to keep that in mind. And we'll get back to this next time. But when we look at these journal entries, there are locations for these journal entries on the statement of cash flow. Now, remember we said there were 3 parts: cash flow from operations, cash flow from investments, cash flow from financing. So we have to determine, first of all, where they go. And if it's 1 through 6, that's when cash comes in. If it's a source of cash. If it's 7 through, it's 11 now, so it's not 10. It's 7 through 11. Then it's a use of cash. And basically what we're trying to do is to look at all the sources, look at all the uses, get the net amount. Okay. I'm going to see if I can insert a column to the right. Okay. And in inserting this column to the right and inserting this column to the right, I'm simply going to tell you whether that journal entry goes into part 1, part 2, or part 3. Now, all of these are going to be sources. 1 through 6 are sources. 7 through 11 uses. So the sources are over here and the uses are here. And so all I want to have happen, what we're going to do now, is to say on the sources. If you issue common stock, that's going to go in part, I think I got Roman numeral here, part 3. So I'm just telling you where to go right now, and we'll pick up at this place next time. If you issue common stock, that's in part 3. Cash received is going to be part 1. Collection on receivables is going to be part 1. Income received in advance is going to be part 1. Money borrowed, if it's short term, is part one, or if it's long term, it'll be part three. And then sale of a non-current asset is going to go in part two. And all of these are going to be sources. When we get to the payments, they're going to be uses. Anytime we purchase an asset, if it's a short-term asset, it'll be in Roman numeral 1, or if it's a long-term asset, it's going to be in the second part. Payment of a liability, if it's a current liability, it's going to be in 1, or if it's a long-term liability, it's going to be in part 3. Payment of an expense, it's going to be in part 1. Payment of a dividend is going to be in part 3. Cash refund is typically going to be in part 1. And a purchase of treasury stock is going to be in part 3. So here is our example, and we want to prepare a cash flow statement from this example. So we would go through each one of these journal entries, and that's where we're going to start tomorrow and get our cash flow statement prepared. So you should look at this, and what I want you to do is to look at which of these transactions you're going to scratch out. So contributed cash of 200, I'll do the first one for you. This is going to go where? Part 3. Because this is a type 1. And so it's going to go in part 3. But if we purchase this inventory on account, this is going to be what? A type 12. But that's not in 1 through 11.
Scratch it out.
So you got it. So we're going to scratch it out. So what I want you all to go through and scratch all these out. Review, a prior session, one of my prior videos where I go through the whole thing and then see if you can get there. So on Thursday, we're going to come back, first of all, and where were we? Burris, this is you. And Manuel, this is you. Okay, so you all will be answering those for me next time. That's your assignment. And then after that, we're going to come back to the statement of cash flow, go over it again, read it, listen to a DVD, and we'll get into how to do that. Any questions?
Yes, can I see this page right here, section B? I think I got, let me see. Um,
Which page?
The page that you're on for the cash transaction decreases. I just wanted to see 7 through 11.
Did I have that? Okay, let me go. Remember, 7 through 11 this is just from the transaction tax. This is what we've
Mm-hmm.
been working with. Those are the transaction tax. That's what we've been working with. Okay.
Okay.
So I'm just showing you that the increases of sources, and I told you where they go and what part. The decreases of uses. And so
Mm-hmm.
your goal is to see that once we put these transactions in the various locations, is this a positive number? Is this a negative number? And is this a negative number? And you're looking like this with an increase in cash. That is, did your cash come from operations? Okay. So we'll be there next time, and then we'll try to finish this up and get a good way next time. We should be finished with it, and then you have a homework thing on this. It's a simpler way we're doing it now. In Principles 2, we do it a little differently because we have too many checks, but we get an introduction to it now. Okay,
Okay.
All right. Thank you.
you're welcome. So work with it. I'll get this recorded and posted. But look at there's some recordings that are going to go further than this. I'm rushing just because I got to get down there because the student who's presenting has a class and she won't start right away. Okay,
Okay.
so you all
Okay.
have
Thank
a good one, and we'll see you all on Thursday.
you
Thank you.
too.
You
Thank
too.
you.
All right, you're
Bye.
welcome. Bye.